This video covers the items that are included in cash and cash equivalents. Just some facts that we need to memorize. So cash, in addition to, well, cash, it also is going to include demand deposits. Demand deposits is just a fancy way of saying the company's bank accounts. These can be checking accounts, savings accounts. Of course, these are going to be included. You didn't need to write that down, but the fact that they're called demand deposits is, and we need to know that term. Okay, equivalents, cash equivalents, short-term, highly liquid investments with original maturities. So the item, when it's first issued, it has a maturity of less than or equal to 3 months. And under equivalents, what specific items are included as cash equivalents? Money market funds, treasury bills. Remember, as long as these items have original maturities of 3 months or less. Certificates of deposit. Often referred to as CDs, and these three again, if original maturity is less than 3 months or equal to 3 months. Okay, let's talk about a few additional items. Deposits held as compensating balances. That are not legally restricted. So I know what you're thinking. What is a compensating balance, or what are compensating balances? These are amounts that when a lender, so you only have a compensating balance when somebody lends you money. So let's say the bank, you go to the bank and you take out a loan of $1 million. And then as part of that loan agreement, the bank says you can't leave with the full million. We're going to hold some percentage of that. Maybe 100,000 has to stay in an account. So you own the account, you own that 100,000, you just can't use it. We are, the lender are going to hold that amount. Amounts required to be held by a lender. It's kind of like a deposit. And what is this for? Well, in case you, the borrower hits any financial troubles and isn't going to pay back, well, at least they have some of it. And that compensating balance typically does earn interest, but you know that's a small compensation for the fact that you're borrowing that money and you're not actually getting access to that money. Okay, another item that's included in cash equivalents, commercial paper. Commercial paper is a short-term note, and it's usually used to finance day-to-day operations. So for things like paying suppliers, so you borrow some money, it's going to be on a very short-term basis, there is going to be interest required on it, and it's used to pay things like paying suppliers, paying your employees, buying inventory. And it's typically only issued, the commercial, this paper, this note, this loan, it's typically only issued by companies with really high credit, and it has a fairly low interest rate. They're known to be very low risk loans. Finally, another item to add under, well, not so much under the equivalents, but under cash, one term to note in addition to demand deposits is petty cash. Petty cash just gets upset about every little thing. Oh no, that's not right. It's not that type of petty. Petty cash, small amount of cash that is left on hand in actual cash on a bank account. So small amounts of cash on hand at a company, and where it's typically just one person has access to it in order to pay small bills that are come up from day-to-day stuff. So small amounts of cash on hand for miscellaneous bill payments, where it's not enough to go through the whole pay authorization check writing process. Then these are usually frequent, the miscellaneous payments that are typically frequent and low cost. All right, so we talked about what items are included in cash and equivalents. How about what's not included? Restricted cash. So the term restricted cash, it's been restricted, meaning it can't be spent. It's set aside in a separate account, and it's restricted. That restriction can either be restricted based on management saying, hey, I want to hold some of these funds aside for plant expansion, buying plant property equipment in the future, and we're deciding that we're not going to spend it. It could be the board of directors saying we're not going to issue dividend payments unless we have some cash restricted set aside for it. And it also may be required. So it may be voluntary by management for operational decisions. So things like future PP&E or future loan repayment. It may be required by a creditor for loan repayment. So that's the other one I'm going to write on here. So it may be voluntarily held for loan repayment, and it may be required by the lender because they want to see that you're setting some cash aside so you can pay off the principal of that loan. Okay, so how do we classify restricted cash? It's not included in the cash account. It would be separately classified on the balance sheet asset section as restricted cash. So what is it restricted for? If the restriction relates to a current asset, let's say we're restricting it so that we can buy inventory, or a current liability, we need to pay this bill within the next year of the accounting after the balance sheet date. Then we record it as restricted cash in the current asset section, as you would expect. And if it relates to let's put it just rather than writing all this out again, if it relates to a non-current asset, you are expecting to purchase plant, property, and equipment, or a non-current liability, you have to pay back a long-term loan, and you're setting this cash aside for that. Then you're going to record it as and report it as restricted cash in the non-current asset section.